I thought this could be a very interesting topic because not a lot of people know what the difference is between 401k, self-direct 401k, and self-direct IRA. Maybe they know at a higher level, but they may not know in the super detail level. And so John right now is with me here today. I'm not going to give everyone a super detailed intro about John. I'm going to let John to introduce himself. But first, let me do this. Welcome, John.
Well, I've been greeted in a worse way before, that's for sure. And Eugene, thank you for the invitation, and for all of you that are participating on this call, thank you for taking your time, which I do value, and hopefully this will be some good information. One quick thing that I'll follow up before I forget what Eugene just said is let's address just real quickly the difference between an IRA and a 401k, obviously besides the fact that one's an IRA and one's a 401k, but practically speaking, what's the difference, especially in the world of self-directed? So the 401k is going to be for an individual, and it can also include a spouse, but it cannot include any employees. But an individual 401k plan would be for any individual who has self-employment activities, where they're operating that business on a full or part-time basis, but they're doing it on an ongoing basis with the intention of generating profit. So if I have somebody who calls me and asks if they qualify for the 401k, I'm going to kind of ask the questions back to them is, do you have self-employment, or, you don't have any employees other than maybe you work with a spouse, etc. But for those people who meet that qualification, even if you have a W-2 job where you participate in a 401k, but you have a side hustle or a side business, you can still have your own 401k plan for that business. In contrast to that, an IRA is going to be for an individual who is either retired, they may be a W-2, but they're strictly W-2, they don't have any self-employment, but they have funds that they want to invest either using IRA funds or, like in Eugene's case, a previous employer's 401k plan, and putting that into an IRA versus obviously a 401k. So those are the two structures that we utilize, and then I'll let Eugene go to the next phase of what he wants to ask about. But that's the main differences between the 401k and the IRA.
Cool, thanks, John. So I wanted to go a little bit deeper into what is, why do people need self-direct 401k, or why people need a self-direct IRA? Like, I wanted to really go deep into this topic and discuss maybe a few different scenarios. For example, like in my case, I was out of, I'm not on W-2, but my wife is, right? But I also wanted you to go deeper into the topics, into like self-direct 401k and self-direct IRA, and sort of go through details like what are the pros and cons of each plan, if you will.
So let's get the 800-pound gorilla out of the room right at the get-go. So a self-directed IRA or self-administered or self-directed 401k, whatever you want to call it, is going to be for an individual, quite honestly, that has an interest in investing into assets outside of what brokerage firms sell. And a lot of times we've been brainwashed as a society to think that the only thing that we can do with our IRA or 401k funds is park them with Schwab, invest in stocks, bonds, and mutual funds. That's just it. There's other options as well. But that's not what the IRS says. So the IRS does not have a problem. There's obviously rules that have to be followed, but the IRS pretty much has an unlimited amount of assets that one can invest into. In fact, They make it very easy for people by saying for an IRA and basically a 401k as well, there's only two assets that you can't invest into, and that's life insurance contracts and collectibles. In 16 years of doing this, I think I've had one person who has expressed an interest in investing into life insurance contracts. So it's really a non-issue. But really, the question for your listeners today is: do they have an interest in investing in an asset outside of what the brokerage firms sell? So let's use an example. Very popular things. The list is long, but if somebody said, "Can I do a real estate syndication?" Sure. Can I buy a rental property? Sure. Can I buy cryptocurrency? Sure. Can I do hard money loans? When somebody asks me all those questions, at some point in time, I'm going to say, if it's not life insurance, if it's not collectibles, as far as an asset goes, you're fine. So we got that one knocked out. So, for any of the listeners who say, well, I'm not interested in investing into any of those assets, a self-directed plan wouldn't be for you. Self-directed plan is going to be for that person who says, I want to invest in things that I feel I can control better or that I have a better knowledge base on versus stocks, bonds, and mutual funds. And those things are all permissible as long as everything's structured correctly. Now, getting back to your situation, Eugene, and for any of your listeners, is in Eugene's case, he's self-employed and his wife is a W-2. So when Eugene and I were visiting, one of the questions that came up is, can my wife participate in my company's 401k plan? And the answer to that, because it's a spouse, is yes, with a big exception. The exception is that the spouse also has to participate in the business. Now, the IRS doesn't say what participation means, so that's kind of based on an individual circumstance. And it doesn't necessarily mean that, Eugene has to do 50%, his wife has to do 50%. It doesn't have to be like, 50-50, but the spouse has to have legitimate participation. So the example I always use is if Eugene had $1 million that let's say he set up a 401k plan for his business, and his wife was sitting on $1 million in an IRA, and he selfishly said, hey, I want that $1 million in my plan because we can use that to make investments that we want to do. That's fine, but you can see from an IRS perspective that if Eugene's wife didn't do anything in the business, why should she be allowed to move monies into a plan that she doesn't even participate in? So it's kind of common sense, but the main thing is for any of you listening, if there's two spouses and both of you participate in that business and both of you want to roll over funds into a plan, make new contributions based on self-employment earnings, you can absolutely do that.
Okay. And what does that participation look like?
Well, the participation could be anything. So, it depends kind of on the business, but, like if I had an Amazon business, my wife might be helping me with just kind of bookkeeping things, invoices, paperwork, those kind of things. If it was anything more significant, like in my case, I set up self-directed plans, for clients. So my wife's not part of my business, but if she was, she would be probably doing things, like, invoices, bookkeeping, helping with plan documents, etc. So it, obviously it depends on just what is the scope of the self-employment. And, when I visit with clients, I get a good feel for what they're doing and if they qualify and if they don't. And sometimes, I'll visit with somebody and I'll say, hey, I know you'd like to bring your spouse in, but I can't stop you from doing that. It's your plan, but I would advise against it because it probably is not compliant with IRS rules. So I don't know that I specifically answer your question because it's kind of like it depends on just the person and what business they're doing.
Okay.
I'll tell you a really funny story if you don't mind the story.
Yeah, go ahead.
I think I might have already mentioned this to you, Eugene, but I have a client who, the husband and the wife work for competing car companies. And as we know in this country, there's not that many big car companies. So I won't mention the names, but they work for very large car companies. And they're both W-2. And there's some benefits to the 401k, that the IRA doesn't have. It doesn't mean that the IRA is bad. It just means the 401k has some really nice options. And she called me, she said, I want a 401k. And so I proceeded to ask her, well, what's your self-employment? And she's like, well, I don't have any. I go, well, you got to have some level of self-employment in order to have that 401k plan. And she literally asked this question. She said, so now keep in mind, her and her husband are over 50. They're sitting on probably $4 or $5 million in retirement accounts, plus their pensions. And so she said, well, what if we do DoorDash? And it took everything for me almost not to laugh because I'm thinking, wait, you're in your mid-50s, you're doing well financially. Why would you want to be doing DoorDash? And she's like, but it's self-employment. And I go, yes, it is. So the funny thing is every time I've talked to her since that time, she usually will say, well, true or not, she'll usually say, guess where my husband is right now? And I go, doing DoorDash? She goes, yep. So the reason I use that story is it can be easy to create that self-employment activity. I just want to make sure that my clients, for their protection, are legitimately self-employed because at the end of the day, if they were ever audited, they have to be able to prove that in order to have that 401k plan, they are carrying on those activities of self-employment.
Got it. So that's very interesting. Uh, and I think it does make sense. Uh, I want to step back a little bit and sort of talk about the like main differences between 401k, self-directed 401k, and self-directed IRA. Uh, like, what are the pros and cons? But I mean, let's just start probably with the self-directed IRA because I know lots of people. I know lots of people in the real estate world that chose self-directed IRA, but some people that I talked to, they they didn't really know why they chose that. They knew that other people chose, right, and they chose as well. So I want to take a moment and go really deep into what are the benefits of self-directed IRA, pros and cons, right? And then we can go to self-directed 401k, and then we can compare both.
Yeah. So again, the IRA is not a bad product, but it really is based on what you qualify for. So without question, the 401k is going to be a better instrument for those people who qualify. So what I would say specifically with some of your real estate friends is they may have contacted a company that only sets up self-directed IRAs, and that may have been the only option. They may not do 401k plans. The benefits of the IRA, quite honestly, that's going to be a really, really, really short list because compared to the 401k, the 401k is just going to shine. So it really gets down to just, do they qualify for the 401k? Because if you gave me equal footings and said, hey, what's better, the IRA or the 401k? In 99% of the time, I will never say that the IRA is better. So it just all falls back to what you qualify for. But let's use the benefits of the 401k vis-a-vis the IRA. So first of all, if you qualify for the 401k, your limitations on IRA contributions are basically $6,000 and $7,000, depending on if you're over the age of 50. Well, compare that to over $60,000 potentially in a 401k plan, and that's per spouse potentially as well. So if you had two spouses working in the business and the business was successful, making money, etc., you could pretty much be putting in upwards to 120,000 into a 401k plan where both spouses are participating. At least 60,000 if it's one. So I always tell people, what's better, 6,000 or 7,000 or 60,000? It's kind of like, that's kind of a no-brainer. The next one I always tell people is I don't tell you what to do. That's not my job. But a 401k plan, and for those of you who are W-2s, you might already have this as part of your 401k plan with a W-2 employer, is you can take out loan provisions. So the loans are loans. But the fact of the matter is an IRA does not have loan provisions where a 401k does. And those 401k loans can be up to $15,000 or 50% of the account balance, whichever is less. So I always tell people if you have at least 100,000 in your 401k, and if you wanted to take out a loan, you can take out up to 50,000. If you had, for example, 80,000, you can take out 40 because it's 50% or 50,000, whichever is less. But again, great benefit of the 401k, whether you use it or not is your decision, but you don't have that option with the IRA. Number three, when we have a 401k plan under the law, like in your case, Eugene, you can be the trustee of your own plan. You don't have to run through a custodian. Anybody who's listening, knows that their IRAs are with a custodian. Like it's typically like a brokerage firm, but that brokerage firm is serving as a custodian, which is required by the IRS. So when we set up a self-directed IRA, we still have to do that. It's not a problem. They still have checkbook control, but they're going to have some additional fees because the custodian is involved, where with the 401k, there is no custodian. You're your own trustee. With the IRA, you have to have a custodian. So I always tell people in the self-directed world, those custodians, they're going to obviously charge some level of fees just to serve in that role. So again, benefit 401k, you can be your own trustee. You don't have to have a custodian. The next one is what I think people should honestly consider maybe to be the most important thing. The IRS has rules that they call prohibited transactions. Think of it as these are the rules that you just cannot do these things and maintain compliance with IRS rules for either the IRA or the 401k. So to do the real 50,000 foot view level explanation, if you had a prohibited transaction, and let's say the IRS caught you in that, with the IRA, it can be almost like a death sentence because if they catch you with that prohibited transaction, your IRA gets distributed. In simple terms, what that means, I always use the $1 million example. Let's say Eugene wrote out a check for $2,000 for some type of an investment purpose with his IRA. And the IRS somehow found out about that for some reason they thought it was a prohibited transaction, and they, kind of audited Eugene, and they come back and they go, hey, you got a problem here. And Eugene kind of proverbially, pulls out his checkbook or his credit card and says, hey, guys, I agree with you. I don't know what I was thinking. I didn't mean to do this, but what tax do I owe? What penalty do I owe? And in some respects, they're going to go, don't worry about it. Well, they're not being nice. So what happens in an IRA when you have a prohibited transaction is you no longer have an IRA. You also
really?
Yes. So if you had $1 million and you had that prohibited transaction, yes, you can try to go to tax court against the IRS. Very few people win there, but you basically would have a full distribution. So you'd be taxed on $1 million. You're also going to have a 10% penalty if you're under the age of 59 and a half, and you no longer have an IRA. So let's just say out of that $1 million, you had 500,000 left after taxes and penalties.
Mm-hmm. Wow.
Well, yeah, you got 500,000, but you would have preferred to keep that in your IRA versus having to take it out as a taxable distribution because of that penalty. Where with the 401k, you have to follow the same rules. But the 401k, the reason I use that 2000 example is because the 401k has a financial penalty based on the amount that was involved in the transaction. So you don't have you don't have a 10% penalty. Your tax and the penalty is based on 15% of the amount that's involved in the transaction. So you're not taxed on that full $1 million. You're taxed on the actual amount that was involved in the transaction, and you still keep your 401k. So to me, that's a huge benefit. And then
wow.
Eugene,
Yes, it is.
this kind of gets to your area probably, is most people, and I understand why, but most people think that an IRA or a 401k can never be taxed until you start taking money out in retirement years. So again, at a kind of a 50,000 foot view level, because I don't want to bore your listeners too badly, is there are two potential taxes that can be applicable to an IRA or a 401k.
Okay.
The first one is a rule that's called UBIT or UBTI. The short explanation is it's not illegal, but if your IRA or your 401k participates in let's say an investment with a company, and I always use the example of McDonald's, and they're getting paid, let's say 3% on everything that McDonald's sells, that particular franchise. That's not illegal, but I can guarantee you that would trigger that UBIT tax because now their 401k or their IRA received profits from a business versus like passive income, for example, an interest return. Because if that McDonald's paid 10% interest, no problem. If they pay 3% of the profits, then that's a potential taxable issue. The other rule, and again at a really high level, is what's called UDFI. It does not, and this is a benefit of the 401k, it does not apply to a 401k. It only applies to an IRA. But where I'm seeing UDFI coming into play is with real estate syndications. Every real estate syndication that I've ever been aware of, the syndicator takes on some level of debt as part of that investment through an outside third party, bank, financial institution, etc.
Right.
It's not illegal. But now what I'm going to tell people is, hey, you want to talk to your CPA because some of those income returns that you have as part of that investment will be taxable because in the eyes of the IRS, that investment return was generated in part based on debt dollars. So it's kind of a complicated topic, but if the only thing your listeners know for right now is that the 401k is exempt from that tax. So even if they made an investment in a real estate syndication with their 401k and they wouldn't be subject to that tax, where their IRA, same investment, would be subject to a tax.
Got it. That's huge. This could be huge. Could you go? Yeah, could you go a little bit more details, like to talk about like what is UDFI tax? Like what does it stand for and why it's being charged?
Yeah, so UDFI stands for Unrelated Debt Financed Income. And I'm a very visual person, so hopefully your listeners are to some degree as well, and I'm just going to use an example. So let's say John is a syndicator, and John says, hey, I'm doing a $20 million project, and he reaches out to a third party and says, if I bring in 10 million of the 20, will you guys, like as a JV or third party lending institution or even a third party person lending the money, but if I bring in that 10 million, will you fund the other 10 million? Well, that other 10 million, between the 10 and the 20 million, that's debt. That is a legal obligation to repay that and all that other good stuff. So now the IRS says it's not illegal. But because half of that investment was generated through debt dollars, the individual investors who have an IRA, they're going to get a K1. And typically the tax is not a huge deal, but I always want to make sure I educate my clients on the fact that they're going to be subject to some level of tax. And that tax is 39%, but it's based on, which is high, of course.
Wow.
But that tax is based on what's on the K1. So a lot of times those numbers, because of the real estate syndicator has quite a bit of leverage with tax deductions and write-offs and those kind of things. Usually what I see is that the actual tax associated with the UDFI tax is not huge, but I always want to make sure that clients at least know that, because here's what I don't want. I don't want a client possibly being in this position where their IRA would have to pay a tax, but they're not aware of it. And then they get that famous letter 5 years later from the IRS saying, you owe us a bunch of money. And they go, why do I owe you money? Well, it was all because of this UDFI thing. So I always want to make sure people know that at the very beginning, so that they know when they make their investments to just ask certain questions, just to make sure that they're understanding if their IRA could be subject to a tax.
Okay. What sort of questions do you recommend people to ask?
Well, depending on what company they use, obviously, everybody's driven by money. So, fees are going to be, a main question. Or you mean to the syndicator, right?
Mm-hmm.
Okay. So I thought you meant maybe to a company like PGI. So with a syndicator,
or could be that too.
Yeah, let's do that. But let's start with the syndicator. So if I was doing an investment with a syndicator now, I would just, ask them, one is, how are your investment returns? Is it based on profits at the end? And I'm getting a percentage plus a share of the final profits, which is what most syndicators probably do. I have told people before that if you want to steer clear of even any potential tax, good or bad, big or small, you could always ask a syndicator that, hey, instead of giving me 10% plus a share of the profits at the end, can I get possibly 15% interest, 12% interest, a little bit higher interest rate, and maybe forego some of the benefits on the back end? Obviously, you have just the logistical things that you want to ask about. How long has the company been in business? What their experience is? What their deals are? How are they secured? All those legal things that you want to make sure of. But bottom line is the syndicators that you probably be working with also probably have some kind of a track record. So it's probably every deal is its own deal. But by asking questions, you can kind of get a feel for in the past, how much debt have you taken on, through third-party sources? Is it 10%? Is it 50%? What typically are the write-offs associated with these projects? What typically might be the K1 values at the end of the process? Because here's the rule. On the K1, anything that's a negative, obviously there's no tax. It's a negative number. Anything the IRS says anything up to $1,000 of profit on the K1 is not taxed. So anything 1,001 and higher then is potentially subject to that tax, again, based on the numbers. So it can vary quite a bit, but usually that tax is not a huge thing. But yeah, I would just ask a lot of questions, just, mostly about the company, their track record, their history. I'd probably also want to try to talk to a couple of their investors, just to kind of see how the process worked. But that's the basic kind of 50,000 foot view level of UDFI.
Okay, cool. Awesome. And are there any other pros and cons between 401k, self-directed, and self-directed IRA that people need to know?
Those 5 I mentioned. Last one, I guess I'll just throw this out, is PGI's fees, as you know, aren't exorbitant. But technically speaking, the person will save some money doing the 401k anyway, because of the fact that they won't have to have a custodian. PGI does have an annual fee, but that annual fee is always less than what custodians charge to serve as a custodian for a self-directed IRA. So I just tell people is, you'll save some money. You're not going to go retire on the savings, but you're going to save some money. By having the 401k, it's going to be a better product for you. Again, as long as you qualify for it.
Got it.
And by the way, one other quick thing, there's only really about 1 or 2 times I suggest that someone not do a 401k. Besides if they're self-employed.
Okay.
If they have Roth IRA funds, like if any of your listeners right now, and again, let's use that visual of $1 million in a Roth IRA, and they go, hey, I qualify for the 401k, I got $1 million, I want to roll over, or 10,000, it doesn't matter what the amount is, but then they tell me it's in a Roth IRA, Unfortunately, we can still set up a 401k, but they cannot roll that $1 million or that 10,000 over because Roth IRA funds are not under current law permitted to be brought into a 401k, which I think is kind of stupid and silly, but it is the rule. So if I'm talking to somebody and they say I have a Roth IRA, I'll say we can do the 401k, but you're not going to be able to roll over the Roth IRA funds into the 401k plan. It's just against the rules right now. The only other benefit with the Roth IRA versus like a 401k would be, for those of you who are knowledgeable on the call about Roth IRAs, how they work, is let's say you're doing very well and you don't want to take out a distribution ever. Well, with a pre-tax IRA, probably most of you have heard of this terminology. There's a rule called, there's an acronym called RMD, stands for Required Minimum Distributions, and they apply to an IRA and a 401k. But with a traditional IRA, by the time you reach 72, the IRS says you have to start taking money out, and there's a formula for that. With a Roth IRA, you never have to take out a distribution. So for people who have, let's say a lot of money in a Roth IRA, they don't feel they need to live on that money in retirement years, they can actually leave that aside for their kids or their beneficiaries because they don't have to take out a distribution from the IRA. So that is one benefit of the IRA, but it really is just tied to the Roth. Like I said, the IRA is not a bad product. It's just, it's not as good as the 401k, quite honestly.
Interesting.
Another thing, Eugene,
Okay.
with your listeners, is there some people who just probably shouldn't have a 401k plan because it is a different structure. There's some rules, that people can kind of get tricked on, like contribution amounts and those kind of things. And I do help clients, with those kind of conversations. But at the end of the day, they may say, well, the IRA is just easier. I don't have to worry about that. I just am able to write the check, do the wire transfer. I'm not putting in contributions necessarily. So that some people might consider that a benefit, but overall the 401k is still going to be a brighter and shinier object for them.
Okay, cool. Can Roth IRA be self-directed IRA, or it's completely different product?
No, it's still a self-directed IRA. And for your listeners, let's boil this down a little bit further. So what PGI sets up is what kind of, it's not an IRS term, it's a marketing term in this industry called checkbook control. So any of your listeners who might be interested in setting up a 401k or the IRA, they will have checkbook control of those funds. So they don't have to get approval. They have to follow rules, of course, but they don't have to get approval from a third party. 401k, like we talked about, easy peasy. Eugene, you're the trustee of your own plan. You pull that trigger when you want to make an investment. You don't have to ask me. You don't have to ask another company, etc. You're the trustee. In the case of the IRA, how we set it up is we have two different structures. One is what's called an IRA LLC. And if any of your listeners Google IRA LLC, they're going to see tons of stuff on the IRA LLC. The other product we have is an IRA trust. Real quick explanation, because they both basically work the same, but the real quick explanation is, let's say you have a client who's in Missouri, just as an example. We would, and they have an IRA account at Charles Schwab that they want to transfer over. So what we do is we set up the IRA account at what most people call a self-directed custodian. They're custodians that don't sell you any investments. They don't sell you stocks, bonds, mutual funds. They're only there to comply with the rules. We get the account set up. Then what my company is doing is we're creating, let's say, a Missouri LLC. We're securing the taxpayer identification number from the IRS. We're providing the operating agreement with very specific IRS language. We provide that to the client, and we provide that to the custodian. So once we provide that to both parties, you would be using those documents moving forward to open up the bank account, and the custodian has those records on file because they won't release the funds to the LLC until that happens. Now, the structure of the LLC, and this is very, very, very important for people to understand, what makes it legal under IRS rules is, for anybody who knows anything about LLCs, there's typically manager or managers, and there's member or members. The members are the owner of that LLC. So when we set this up, and this has to be done legally, we set, for example, Eugene up as the manager of that LLC because it's his IRA account. He, is doing the day-to-day activities of the LLC. The member will actually be his IRA, which is not a person, but it's an important legal distinction because in the eyes of the IRS, if I did something wrong and set up Eugene where he's the member and the manager, he would be in violation of IRS rules, because now how the IRS would look at it is they would say, Eugene, you have control over everything. you personally own this LLC. And
Right.
usually can't personally own the LLC. He can only manage the LLC. So it's a small distinction, but a very, very important distinction in order to make sure that you can control the checkbook and not violate IRS rules by controlling the checkbook.
Okay. So that makes sense. And let's dive into this topic. So, for example, before someone would choose self-direct IRA or 401k, self-direct 401k, right? Let's say they are becoming self-employed. When they're becoming self-employed, they don't have any employees at the moment, right? But they don't know whether or not they will have employees in the future. And how would someone deal with this type of situation?
Great question. So I'm going to answer that in two ways. One is on the 401k plan documents. I give people, and legally give people, this is permitted under IRS rules. I legally give them a little bit of an out. And what I mean by that is, let's say, Eugene, we have your plan set up, you already know what we're doing with you, but, we have your plan set up, and all of a sudden, 6 months later, things are going gangbusters for you, and you hire somebody. And you forget what I said about, no employees. You call me up and go, hey, John, I hired somebody. I think that's okay. And I'm going to say, well, actually, no, that's not. But the good news is you have a stay of execution, so to speak, for up to a year, where you do not have to include that person in the 401k plan. Mm-hmm. After the year, though, you have to. So then my conversation with Eugene would be okay, that's fine. You got that year period. But what we should probably then do within the next year, unless you want to include them in your individual plan, which is what the Department of Labor would require, is you can then terminate the 401k plan, move everything over to a self-directed IRA. So I get probably 3 or 4 calls a year where people go, hey, I'm not self-employed anymore, or I'm thinking about adding an employee. Then I'll just say, hey, the easiest thing would be is if we terminate out the 401k plan. So yes, that's not great, because maybe it was benefiting you from a contribution standpoint, but you're also probably not wanting to, as the employer, put money into a plan for an employee or multiple employees. So at that point, I'd probably just say, we can, if you want, tell me what you want to do, but we can move you over to a self-directed IRA. That's not a problem at all.
Okay. And how difficult that process is?
That's not difficult at all. It's just a matter of terminating the plan, doing some reporting, final reporting of the plan being terminated to the IRS. There's a few steps with that. If you want me to be really boring, one is you have to issue a 1099, to yourself from the plan. You have to do a form that's called the 5500 Easy, where you'd be reporting that it's a final reporting of the plan, and the plan is being terminated. So it's not real difficult. It's just a process that you have to do. But I tell people is if you can benefit from the 401k, like I have a guy right now who realistically is probably going to add at least 1 employee in the next year or 2. So usually when the time frame is that short, I kind of might suggest hey, why don't we just do the IRA, not worry about it, because you already know you're going to be adding an employee. In his case, he was fine. He just said, well, hey, but I still get the benefit of the year with contributions, being able to make some decent contributions to the 401k. So he goes, can I do it for the year? And then he goes, I might not even add an employee, but if I do, can we just terminate it then? I go, yeah, you can. It's not a problem. So in his case, I was kind of suggesting that he go the IRA, but he still wanted to have the benefit of the 1 year because he was planning on making larger contributions to the plan.
Okay, interesting. And let's say you have employees in the future, you move everything from 401k to self-direct IRA, and then if you want to issue your employees a 401k plan, will it be something separate completely from your self-direct IRA? Will it belong to a company? Like how would those different plans communicate with each other, or they don't have to communicate at all?
Yeah, that's a great question. We are digging real deep now. So the digging deep part of it is that from a 50,000 foot view level is the IRS and the Department of Labor basically say, hey, Eugene, if you're going to hire people and you got a 401k plan, you can't be the only one benefiting from it. You have to also benefit your employees. And that typically will include like an employer match. So a lot of
Mm-hmm.
times people who are small business owners, like people like you, me, et cetera, where we know we're not having, employees and all this kind of stuff. Once you start adding employees and you're being told, hey, under the law, in order for you to participate yourself, you're going to have to start also putting in employer matching contributions into the plan. It's called safe harbor. It basically where, the employer has to put 4% of their pay into the 401k plan out of the employer's pocket, not the employee's pocket.
Right.
So a lot of people who are, smaller businesses, they were like, yeah, I don't want to be doing that and getting involved in that. Plus, the other thing is when you have multiple participants, with an individual plan that PGI sets up, there's very little oversight from a compliance standpoint. Once you add one employee, they're going to have to go out and hire what's called a TPA or a third-party administrator to actually do the paperwork for that. And then those companies who do that are typically going to be charging $2,000, $2,500 annually just to do that. So in my world of individual 401k plans, it's just probably not worth it. If Eugene hires one person, the first thing I'm going to say to him is, well, right off the bat, you're probably going to be spending a minimum of $4,000 a year out of your pocket just for this one person to participate in your plan. Would you want to do that, or would you prefer just to possibly do a self-directed IRA?
Got
Most people are going to say, yeah, I'll just move it over to a self-directed IRA.
Got it. Okay, that's a good point. So let's step aside from this conversation for now, and I want to touch really briefly on the situation. For example, if two partners are on W-2, right? But they do want to have control of where they want to put money into, right? Where they want to invest money into. Like if you're on W-2, yes, your employer gives you a 401k plan, but I think those contributions that you're making, they're only being reflected in the stock market, right? Or bonds, right? So you can't really make any decision into like where you want to invest outside of the spectrum that you're given by the
administrator.
Yes. Yeah. So how would you, what would you recommend?
Yeah, so here's where we just get down to the nitty gritty of just how the rules work. But it's a great question. So it used to be when I first started my business 16 years ago, that if somebody called me and they said, hey, I'm in a 401k plan, I want to self-direct, I'm all ready to go, they're excited, all that good stuff. And then I go, well, wait a minute. Is this 401k plan a previous employer's 401k plan, or is it a current 401k plan that you're participating in? If they say a previous 401k plan, not a problem. You can access those funds. If they say it's a current plan, then that all is based on the plan that they're currently under with that business and the plan administrator's rules. So let's use an example. If you called me and you said, hey, I work for Microsoft and I got $500,000 in that 401k account, and I want to get an IRA or a self-directed individual 401k plan set up. Tell me how I go about getting, let's say $200,000 out of that Microsoft account. I'll say, well, you got to go back to Microsoft actually, because you're going to have to ask them if their plan allows you to move any monies out of the plan. And even when companies do, there's a formula for it, and they will tell you exactly. But not every plan, not every company gives you that option, and that's the reason I use Microsoft as the example. A lot of the newer companies, maybe tech companies that are trying to provide tons of benefits for their employees, will set up their plans to permit people to take money out. There's a formula for that. But a lot of the just rank and file businesses out there don't allow their employees to do that because they don't want to have their plan in a situation where people are always just going back and asking for money to be taken out because it costs them money in administration fees because they're the company sponsoring the plan. So the long and short answer is it depends. So you might be working for a current employer that will allow you to take out funds. You just need to ask them, and they'll know what you're asking. You just say, hey, can I roll out any monies into the plan to another retirement account? They'll say yes or no. If they say yes, great. Then your next question is, how much based on the balance that I have can I take out? And then if they say, well, you got 200,000 and you can take out 100,000, okay, great. That 100,000 might be sufficient enough for them to make the type of investment that they want to make. But if the plan says you can't take it out until you're either 59 and a half or you terminate service, that's just what it is.
Okay. And what type of plans you can actually, if you're allowed to take money from your current 401k plan, are there any limitations in regards to a plan that you can put that money into?
No, you could roll it over again. It's just, going back to the 401k with qualifying, you can roll it over to any retirement account. Obviously, if it's a 401k, we'd want to make sure that you're actually self-employed, like we were talking before. But if you said, hey, I'm with Microsoft and I don't have any self-employment, but I want to self-direct this and I want to move 200,000 and Microsoft says, yeah, I can do that. Yeah, then we just set up a self-directed IRA, but you can move it to any retirement account. It's just a matter of qualifying, for that particular retirement plan.
So it looks like a self-directed IRA would be the best choice for people who are still on W-2.
Absolutely, yeah. W-2 with no self-employment. Because going back to my couple that I talked about in Michigan that work at the two different, car companies, well, I mean, if they have legitimate self-employment, they can move it to a 401k. So if you have one of your, one of your clients and stuff who, let's say, does Amazon, and they're working Amazon as a side business, they can move it over to a 401k tied back to that Amazon business. But if they're strictly W-2, no self-employment of any kind, yes, they can move the funds out, but it would have to go to a self-directed IRA.
Okay. So just to make it clear, if two people on W-2 and there are no other jobs or self-employment gigs, self-directed IRA is the best choice. But
let's use you and your wife for example. Let's say your wife's a W-2, and let's say you were a W-2, and you guys both want to self-direct. We would just have to set up two self-directed IRAs. Which, by the way, there's another good answer to a question. Two spouses, for example, it doesn't have to be spouses, but that's the typical situation. You and your wife, if you were in that situation, could both roll over monies to an IRA through a self-directed custodian. Then each of your funds could fund one LLC. So that is permissible to do. It's what's called a multi-member LLC. So in that case, Eugene's IRA is one member. His wife's IRA is one member. There's some other rules that, I talk to clients about as far as, things that they have to make sure that they follow. But yes, like if you're, in your case, you're self-employed, but if you were strictly W-2, your wife is strictly W-2, and you wanted to both use retirement funds and put into one LLC, that is legal to do.
All right, cool. So that's awesome. I did not know that.
I have one client right now who's a 401k client, but he and his family want to do, and there's some rules with this that I won't bore people with, but he has 9 family members that they all want to put in an equal amount to fund an investment all together. And as long as that's done correctly, paperwork wise, and it's all done at one time, like in his case, I told him, I've never dealt with 9 people. Usually it's just like 2 people, like, 2 spouses.
Yeah.
But I said, technically, we could create that LLC with 9 members. And, you just want to make sure you do all the paperwork correctly as far as, who's entitled to what percentage of the assets and the investments and all that kind of stuff. But yeah, you can potentially do it.
That's super cool. And let's say let's say 2 spouses on W-2, and let's say you have like a small gig on the side, right? Like in this case, I think you mentioned, let's say you sell some things on Amazon, right? And so that gig sort of qualifies you as a self-employed, right?
Yeah, absolutely. Just like the DoorDash example.
Okay. Do you need to have anything legalized for IRS to see that, yes, you are self-employed in that specific category?
No, not specifically. So, all of us have heard the term sole proprietor. So if a person's a sole proprietor, they're sole proprietors, and that can be 2 spouses, 2 partners, two spouses, 2 partners, etc. Now, if you get into an LLC, which, unless it's filing taxes as an S corp, is still considered a sole proprietorship, but it's under that veil of the LLC. If you have an LLC filing as a sub S, that's a corporation. If you have a C corp, that's a corporation. With the S corp and the C corp, that's obviously things that you have to file for with the IRS to get that classification. But
right.
If you're just a sole proprietor, yeah, like if I was doing Amazon or DoorDash with my spouse, We could be sole proprietors. We could have a 401k plan, like in one of our names. If we formed an LLC, that'd be fine too. So yeah, you can absolutely do it. That's not a problem. But as far as to answer this first question is you don't have to quote unquote get specific permission from the IRS to have a 401k plan or to do something paperwork wise to tell them that you're a sole proprietor. You just have to operate the plan correctly. Now, if you were obviously an S Corp or C Corp, you'd be having filing paperwork and tax returns that you'd be filing on behalf of the S Corp or the C Corp, of course, for your business. But that in and of itself wouldn't be dictating what you have to do for the 401k. The rules would be the same for the 401k.
Let's say you're a sole proprietor. Do you need to go and set up the entity as a sole proprietor in order to have a plan?
Yeah, here's what you don't have to. We're doing, this is deeper level now. But what I suggest is when somebody is a sole proprietor that we actually secure a taxpayer identification number, or what most people refer to as an EIN, for you as a sole proprietor. So let's say Eugene is a sole proprietor and he wants to set up a plan. Instead of using his social security number, which is legal, but there's reasons why I don't suggest that we do that for clients, is I would say to Eugene is, hey, Eugene, we have to get an EIN number for the plan. That's required. That's no big deal. It actually protects you better. But I would tell somebody is we have to get an EIN for the plan, the 401k plan. But I'm also going to suggest that we actually get an EIN for you as a sole proprietor. There's two reasons for that. And this is where it's getting a little deep, but hopefully people won't be too bored with this explanation.
Well, you can use this. Use the story.
Perfect. So the reason I would suggest that Eugene have a TIN for himself as a sole proprietor is because, number one, from a security standpoint, it's better if any bad guy is going to steal identification numbers, it's better that they steal a taxpayer identification number versus your social security number. And everything you would be doing then with the sole proprietor, you'd be using that taxpayer identification number, not your social security number. That's what the IRS wants you to do. The other thing is there's a form I mentioned just real quickly earlier called a 5500 EZ that is the only reporting thing that people have to do potentially, and that's when you have more than when the fair market value of your 401k plan is more than 250,000. You have to send a form to the IRS every year, just kind of reporting the numbers. So here's the funny thing, and I'm sure the IRS has wisdom in why they did this, but when you file the 5500 EZ, you can't put in a social security number. You have to put in a business taxpayer identification number. So if Eugene is a sole proprietor and he has to fill out this form, and let's just say we didn't get him an EIN for himself as the sole proprietor, he's going to call me when he does the 5500 EZ, and he's going to say, hey, John, where do I put in my social security number? I'm going to say, well, guess what? You don't. They don't want you to put in your social security number, and then you're forced to get a taxpayer identification number when you have to fill out that form anyway. So when I work with people as new clients, I just say, hey, if you're a sole prop, let's just get a taxpayer identification number for you. The IRS wants you to do that anyway. It's better for you from a security standpoint in case anything's ever stolen. And oh, by the way, when you end up having to do this form, you're going to have a TIN at that time anyway.
Interesting.
Really good question.
Okay, cool. Well, how these plans, self-direct IRA and 401k, are different from life insurance? Because a lot of people that I talk to, they also have life insurance. And how would you recommend, first of all, let's talk maybe a difference between life insurance and 401k and self-direct IRA, right? And then maybe go a little bit deeper into why would someone choose life insurance over 401k or IRA plans, or maybe it doesn't have to, maybe it's just an addition.
Yeah, absolutely. So, and for all your listeners, Eugene and I aren't trying to, sell you on you got to do life insurance.
Yeah, or like we're not selling to anyone. It's just a conversation about how do you use this type of plans and why do you want to use them?
Yeah.
So we are not. It's not legal advice that I forgot to mention at the beginning of the presentation. We are not lawyers and we're not CPAs, so talk to your CPAs and legal advisors.
Yeah, obviously the first one is, a 401k and an IRA, they're viewed as retirement vehicles where, realistically, no, people don't typically look at life insurance and go, "That's a retirement vehicle for me." They go, "I have a 401k, I have an IRA, et cetera," but they don't necessarily coin life insurance as a retirement vehicle, and that's a smart thing to do. Just like I would always tell somebody, life insurance is not an investment; it's life insurance. So now, when you go down the path of life insurance, we've all heard the saying, "You go down the road, and there's a fork in the road." So one fork of that road is there are people who their main concern is just having a death benefit. So obviously, if something happens to them, their spouse is taken care of with some death benefit funds, their kids, etc., whoever their beneficiaries are. What you and I are talking about is a policy that is typically set up as a whole life. It doesn't have to be. It can be like a universal life policy, but it's cash value. Those two words are very important for your listeners to remember. Cash value, and this is kind of going to sound oxymoronish, but bear with me, folks. A cash value policy, a lot of people will associate a tremendous value associated with that. There's a lot of people who have written books on this topic. But the general premise is that you want, in the case of a person who wants life insurance for their family, what's the thing? They want the lowest premium with the highest death benefit. In a cash value policy, it's the exact opposite. You have to follow, the insurance companies have to follow certain IRS rules, but what you want, Eugene, in the sense of a life insurance policy that's a cash value policy, is you want a lowest death benefit, which sounds weird, right? You want as low of a death benefit as possible with the ability to put in the highest amount of premium. Why do you want that on a cash value policy? Because the insurance company then, let's say you were paying $1,000 a month, but your insurance, the actual cost of the insurance was, let's say, $200. As long as they're following IRS rules, which they would be, that additional $800 gets invested through the life insurance company. Now, what that does is every year you have that policy, year after year after year, your dividends increase, the cash value of the policy increases, etc. So there's two benefits with that. You're young, Eugene, but let's say you had $50,000 of cash value in your life insurance policy. It's a concept people call bank on yourself or infinite banking and those kind of things. Now, if you wanted to, instead of going and getting a car loan at 5-6% interest, you could take a loan out of your life insurance policy and buy yourself a car. And the thing that's kind of nice about it is most people should probably pay their life insurance policy back, but you're not required to. So as long as you have the cash value, if you want to take all $50,000 out and go buy a car, you can do that. So a lot of people talk from a financial standpoint about leveraging that. So like when they have major expenses, don't take out loans, don't put it on credit card. Take the money out of your life insurance policy, pay it, and then pay the money back, or don't pay the money back, or pay some of the money back. But most people would say yes, try to pay all of it back, etc. But the other benefit then with these cash value policies, we're speeding up the clock now. Now I'm going to say, Eugene, you're 70 years old, and you still have this life insurance policy. Let's say you have a death benefit of a couple $100,000, but you're sitting on $400,000 of cash value. Now, one of the strategies is you could literally take that money out. They still call them loans, but they're not loans in the sense that you have to pay back. But it's the closest thing to having tax-free money in retirement years, because now Eugene might say, he's 70 years old, he might say, hey, insurance company, I want to take out 1/15 of this money over the next 15 years, and it's going to come to you tax-free.
Oh, wow.
And that's a huge benefit, because when people typically need money the most is going to be in retirement years. So if they're disciplined enough to keep the insurance policy, keep it going, keep it funded, pay the premiums, don't let it lapse, you're going to be sitting on a decent amount of chump change in that policy as far as cash value that you can take out tax-free in retirement years. And by the way, the value of the cash value policies is you can use the cash in the policies however you choose to use it. You can take it out at any time. You don't have to be approved for a loan. It's your money to take out from your policy. And then in retirement years, the benefit is whatever cash value you have, besides the death benefit, you can start taking that out of the policy tax-free.
That's awesome. And basically, you can invest in anything you want to invest, right?
You can do it with that money. You can do anything you want. In fact, a lot of Going back to the real estate syndications, a lot of real estate syndications, not only because they believe in the value of the product, but a lot of real estate syndications actually promote that with some of their clients because it's also an additional way for them to make investments into a real estate syndication because they might be like, hey, I got 50,000 of cash sitting in my life insurance policy.
Yeah,
Can I take that out and invest it with you guys? And the answer to that is yeah.
that's awesome. So, what are your recommendations for people? Would you recommend using one of those three, or would you recommend using maybe a combination of these plans?
Yeah, I mean, one could certainly, it's all situational based on the person's, situation. They may not have liquid cash to invest. The obvious thing is if you're using personal funds, you're going to be subject to capital gains, those kind of things, et cetera. But, with the retirement accounts, those are just going to be investments out of the plan, just like look at it similar to a stock or a mutual fund. Instead of buying a stock or a mutual fund, you're buying a piece of a syndication or you're buying a rental property, but it's still an asset that's going to continue to generate monies back to the plan by either appreciation, for example, in real estate, by the value of the property increasing and obviously the value going up, rental income, those kind of things. But, the life insurance to me is something, this is just my own personal opinion, is yes, I have clients who use the life insurance policy to make investments out of that plan. To me, I think the wonderful thing about the life insurance policy is it gives you those tax-free policy loans in retirement years when you need it the most, and you're still providing your family with that protection of a life insurance policy for the death benefit in case you pass away. So to me, I would say, all things being equal, if you qualify for the 401k, that's probably number one on the list. But it doesn't mean that the IRA is second fiddle. It doesn't mean that the cash value life insurance is second fiddle. It just depends on, here's the biggest thing with life insurance. Somebody might say is, well, I don't want to be putting money into a life insurance policy.
Mm-hmm.
Then don't, then use a self-directed IRA, self-directed 401k. And then the obvious thing, which we said at the very beginning is no one wants to set up a self-directed plan unless you're planning on using it for non-traditional assets. So there's no reason for your listeners, there's no reason at all to set up a self-directed plan if all you're going to do is stocks, bonds, and mutual funds. You don't need PGI. You don't need Eugene for that. You don't need to pay money for that. Just go open your account at Schwab or Fidelity. But for those of your listeners that want to do things, the real estate syndications, the hard money loans, the cryptocurrency, the rental income, for a rental property,
Yeah.
that's the only vehicle, a self-directed plan, either with the IRA or the 401k, that's going to be the only way you can do that.
Cool. And for the when you contribute money, for example, to the whole life insurance plan, are you contributing money pre-tax or post-tax?
It's always after tax. And
It's
that's why
always after
you
tax.
can take out that money in retirement years with no tax penalty whatsoever, because you're just taking out the growth on those after-tax funds, similar to a Roth. If you
Got it.
Roth investment, you're going to grow tax-free, right? Same with life insurance. It's not Roth. I want to make sure that's clear to people. It's not a Roth plan, but it feels like it's Roth because it's all after-tax funds. And then there are limits on how much you can put in. Because a long time ago, the IRS nipped that one in the bud, because what you would do is you'd find a lot of wealthy people who would put a ton of money, like they'd purchase a death benefit, but then they'd put in like $2 million extra.
Mm-hmm.
Well, it didn't take long for the IRS to figure that out and go, whoa, wait a minute. So just because you can what I call overfunding a policy, it still has to keep within a formula and a calculation that the IRS imposes upon life insurance companies. So like in your case, Eugene, you couldn't have a death benefit of like $100,000 and then be pumping in, $5 million a year into it. It just doesn't, it's just not permissible to do, but you're able to put in up to a certain amount of money well over and above what the actual cost of the insurance is. So let's just say, using that example from before, let's say your death benefit for the life insurance was $200, but the insurance company said you can put in up to $800 a month or $1,000 a month. Well, that $800 is that extra money that you're putting in with the intention of just letting it grow, letting it grow, letting it grow, taking it out when you want to take out loans from the whole life policy, using it down the road when you want to take it out in retirement years for living expenses.
Yeah.
That's the benefit of the whole life policy.
Nice. So, okay. someone wants to put $2 million, but IRS would say like, hey, you really can't do that. But it seems like you can open multiple plans and spread that $2 million across multiple plans.
Potentially. There is still a cross comparison between what you have. So, I mean, you could probably do that, and the IRS probably wouldn't know that. But again, as you know, with my personality, I never suggest that people do things to tempt the IRS into investigating things. But you still, yes, are going to be limited. But the general question is, could I potentially have 2 or 3 different life insurance policies? Yes, you could.
Got it.
In fact, a lot of people, what they'll do is the typical funding for the life insurance is at least 7 years. Now, if it's whole life, that's obviously whole life is going through your entire life.
Yeah.
But even if you didn't do a whole life, let's say you did a IUL policy, a lot of people, they'll fund that for 7 years. And then if they like it, they'll turn that one off, the spigot, so to speak, and then they'll open another life insurance policy and fund that one for 7 years. There's a lot of people who do that.
Okay. Awesome. Well, hey, John, that was a super informative conversation. How people can find you if they have any more questions or they want to set up any plan like self-direct IRA or self-direct 401k or whole life insurance policy, how people can find you so you can help them out.
Yeah. So if you don't have them kind of reach out to you first, because obviously you have my contact information, but I'll say this slow in case anybody wants to, jot it down. My direct number is 602-684-2922. The website is PGI, so that's P as in Paul, G as in George, I as in India, selfdirected.com. And then my email is John, John, at pgiselfdirected.com. Awesome. And by the way, I'd be treating your listeners a little bit more special than I treat everybody special, but I'm still treating them a little bit more special. So just let your listeners know, and they're going to hear this anyway as part of this presentation. But just let them know that when they call me to inform me that they heard of PGI through this webinar, and I'll give them a little bit extra TLC.
Oh, wow. There you go, guys. So reach out to John if you have any more questions. John, thank you so much for coming. I really appreciate it. I think it was very informative. I actually jotted down some of the things myself that I need to know about this type of plans, even though we talked a lot on the phone. But it seems like there's a lot more to uncover, which probably we don't have time to do that.
It's kind of like Christmas. You open up the box and you're finding out, oh, there's a couple other gifts in here that I didn't know were at the bottom of the Christmas package.
But yeah, I guess in this case, you can't really return them, right?
Yeah, absolutely. And you know my style, so I do like to educate people. So I'm not doing the sales pitch, but if any of your listeners call me, you know how I'm going to visit with them, and I kind of dig deep a little bit just to make sure I explain everything. Hopefully not boring them to tears, but so they have a good education on how these plans work.
Awesome. Thank you, John. And thank you guys for joining us today. We'll see you guys soon.